Welcome to the deep dive.
Oh.
Okay, so today we're diving into something pretty fascinating. It's essentially a blueprint for scaling services in the digital age. We've got the draft Red Herring Prospectus, the DHRP from Urban Company Limited.
Yeah, and this isn't just, standard corporate filing. It's much more. It really lays out the strategic DNA of a company tackling a massive challenge.
Which is?
Well, how do you professionalize and digitize human services like home repairs or beauty treatments at a huge scale? It's a real masterclass in operations, finance, people management, the works.
Absolutely. And our mission here, for you listening, is basically to act like the chief editor for a new business leadership series you're planning.
Right.
We need to pull out the actionable stuff, the key insights, nail down some compelling themes for different functions, and maybe draft some challenging questions. Think operations, finance, marketing, HR.
Yeah, all the core areas. So let's define the company quickly. They call themselves a technology-driven, full-stack online marketplace.
Full stack meaning they handle everything, not just leads.
Exactly. Focused on quality home and beauty services, and the scale, as you mentioned, is pretty big already, 59 cities.
Wow.
Yeah, 48 of those in India, plus UAE, Singapore, Saudi Arabia. That's as of late 2024.
Okay, so as we unpack this, we should probably use their own core principles as a guide, right? They talk about three things.
Mm-hmm. Consumer excellence is the first, then service professional empowerment.
And the third?
Technology, the tech-enabled platform that ties it all together. We should probably explore the tension between these two.
Good point. Okay, let's get into it. All right, part one, operations and strategy. Let's start with the sheer size and diversity. You said 59 cities, 4 countries, India, UAE, Singapore, KSA.
Right, very different markets. And the service range is huge. You've got basic stuff like cleaning, pest control,
Okay.
all the way to skilled trades. Electricians, plumbers, carpenters, appliance repair, and then personal care, skin care, hair, massage therapy. It's broad.
The operational complexity just to maintain some level of quality across that, from like fixing a tap in Dubai to a massage in Delhi.
It's monumental, absolutely. But what's really interesting, operationally speaking, is this strategic pivot they mentioned. They're moving beyond just connecting people.
Oh, so?
They're getting into products, tangible stuff, under their own brand, native.
Vertical integration. Classic move. So not just sending the plumber, but selling the faucet too.
Kind of. They started with things like water purifiers and electronic door locks.
Interesting. Why those?
Well, 2 big reasons, probably. First, obviously it's a new revenue stream, likely higher margin than just the service fee.
Makes sense.
Second, it gives them control over the quality of the actual product being installed or used. Think about it. If the lock they install fails, who gets blamed?
The platform, yeah.
Right.
Okay. And the electronic door lock market, is that significant?
According to the DHRP, yes. It's projected to grow super fast, like 37 to 40% a year.
Wow.
Turning into potentially a $210 million market by, CY 2029? That's a serious incentive to rejig the operating model.
And the numbers back this up.
Yeah.
Is this native brand thing working?
Seems like it, yeah. The revenue figures are pretty stark. It went from about $38 million in fiscal 2023
Okay, modest start.
to almost $760 million in just the first 9 months of the next fiscal period, ending at least in 2024. That's explosive growth.
But that's a huge operational shift, right? Going from mostly asset-light services to managing inventory, supply chains, warranties for hardware.
Massive shift, calculated risk, clearly. But it shows they're willing to evolve the model if the opportunity is big enough. It puts huge pressure on entirely new capabilities like logistics and fulfillment.
Okay, let's switch gears slightly but stay in operations. The risks. What keeps them up at night? The DHRP mentions one thing repeatedly.
Platform circumvention.
Yes.
The eternal headache for any marketplace.
Explain that a bit.
Simple, really. The platform connects the customer and the service pro. They have a good experience, maybe build some trust.
Right.
So next time, why not just call the pro directly? Skip the platform, avoid the fees or commission.
The platform gets cut out. It's that gig economy tightrope, isn't it? How do you stay essential after making the intro?
Exactly. And they know it. The filing talks about mitigation efforts, like making it impossible to cancel a service once it's technically started. Small things, but it shows operations isn't just about efficiency. It's about protecting the core monetization channel.
So the lesson for any marketplace business listening is trust is built on the platform, but revenue can easily leak off it.
Precisely. And their strategy to fight this isn't just rules and contracts. It's deeply tied to their tech, which brings us nicely to quality control.
Okay, This is where it gets really clever, I think. Standardizing a human task at scale. How are they using tech?
Well, one way is by embedding tech into the physical stuff. These barcodes on consumables.
Like cleaning supplies or beauty products, even their own native brand stuff.
Exactly. Barcoded right from the warehouse. That guarantees authenticity. But then they track the usage of these items during the service itself. The Service Pro scans the barcode using their dedicated app as they use the product. So the tech is essentially auditing the physical work in the customer's home in real time.
That's pretty granular control. What about more technical jobs, like appliance repair?
They mentioned something called smart jigs and proof collection.
Meaning?
Sounds like the pro might have to use a specific tool or maybe an app feature to prove they diagnosed the problem correctly or completed a specific step properly. It creates an audit trail.
Okay, so this whole system, the barcodes, the smart jigs, the real-time app data, that's how they back up that claim of a 4.82 average customer rating.
That's got to be a huge part of it. It's tech enforcing the standard.
Right. So if we're thinking about your new leadership series, this operations part is a goldmine. The sheer complexity of managing quality across 59 cities. That's the story.
Definitely. How about a theme like the technology of trust? Scaling quality control in a fragmented service market.
I like it. Okay, let's frame some deep dive questions for an operations leader based on this. 5 key challenges.
Okay, number 1, how do you balance that aggressive growth, expanding cities, getting new categories like hardware against the very real risk of stretching your quality control and support systems too thin? That's basically risk factor 5 from the filing.
Good one. 2, what's the long-term plan, tech and legal, to stop that platform circumvention? Beyond just blocking cancellations, what deeper data analysis or legal structures do you need to stay indispensable, especially given risk factor 6?
3, how exactly does the tech jakes, those smart jigs, the barcode scanning, the app audits, how is it designed and rolled out to standardized services across such a wide skill range from, basic cleaning up to complex appliance diagnostics? That's a huge implementation challenge.
Yeah, definitely. 4, with the new native product lines, how do you integrate the logistics, the inventory management for physical goods, with what needs to remain fundamentally an asset-light service platform? There's a real tension there operational.
True. And 5, thinking about the global spread. Singapore's regulations versus India's state variations versus the Middle East. What's the operational playbook for managing compliance? You need consistency, but also local adaptation across dozens of jurisdictions, labor laws, standards. It's complex.
Immense complexity. Okay, that gives a great foundation for an operations discussion. So they can scale quality, they can expand the model, but does it make money? Let's pop the hood on the financials. Are these big, complex operations actually, translating into profit?
Well, the financial story here is really one of improving discipline, and like a lot of high-growth tech firms, they rely heavily on non-GAAP metrics.
Right, metrics that strip out some of the accounting noise to show underlying performance.
Exactly. The first big one they highlight is contribution margin. This is key. It tells you if they're making money on each actual transaction.
And how do they calculate that? It's important to be clear.
They lay it out. Revenue from operations minus all the direct costs associated with that revenue. So cost of the service or the goods, payment gateway fees, communication costs, customer support, refunds, logistics, even cloud hosting. Everything directly tied to delivering the service.
Okay, that seems pretty comprehensive. And what's the trend? Is it getting better?
Dramatically better. And this is central to their financial narrative. The margin went from 11.80% in fiscal year 2022 up to 19.43% for the 9 months ending December 31st, 2024. That's a huge jump.
What does that jump tell you?
It suggests they're getting better at pricing, much more efficient in delivering the services, or maybe utilizing their workforce better as they scale. Probably a mix of all three. It's proof the operational strategy is starting to pay off economically.
Right, the unit economics are improving. What's the second key non-GAAP metric?
Adjusted EBITDA. It's a bit more complex. Aims to give a clearer view of overall financial health before things like interest, tax, depreciation.
How do they calculate that one?
They start with profit before tax, then they add back finance costs, depreciation, amortization, share-based payments. But then they subtract lease liability payments. It gives a sense of cash operating performance.
Okay. And the trend there?
This marks a really critical turning point for the company. The adjusted EBITDA margin improved significantly. It went from being deeply negative, minus 24.77% of their net transaction value in FY22.
Ouch.
Yeah, losing a lot, to actually breaking even,
Yeah.
a positive 0.38% in the 9 months ending December 2024.
Wow, so they crossed the line into positive territory on that metric, even while still growing.
Exactly. Hitting positive adjusted EBITDA is a massive milestone for a company like this. It suggests the years of investing in operations and tech are starting to yield bottom-line results, even with increased spending on things like marketing and incentives.
And does the cash flow back this up? Are they actually generating cash now?
Yes, another positive sign. The summary shows their cash flow from operating activities flipped. They were burning cash in previous years, but in those 9 months to December 2024, they actually generated net cash of about $453 million.
So the efficiency isn't just on paper, it's real cash.
Right. Operational efficiency turning into tangible cash.
Okay, speaking of cash, let's look at where they plan to spend new money, the objects of the offer, how they'll use the proceeds from the IPO's fresh issue. This is like a strategic roadmap.
It definitely tells you where their priorities lie. The biggest chunk, by far, is $1,900 million earmarked for tech development and cloud infrastructure.
So doubling down on that tech as the standardizer pillar we talked about, serious money behind that.
Absolutely. But here's where you see the tension, maybe a point for debate in your series.
Okay.
$1,900 million for tech, but only $800 million for marketing. Now, remember that statistic, less than 1% online penetration.
Right, the market is overwhelmingly offline.
So shouldn't the priority be driving mass adoption, changing behavior? Does that capital allocation feel maybe a bit unbalanced? Prioritizing internal tech over market conversion.
That's a really sharp question for a CFO. Why build more tech if people aren't using the platform yet? Interesting tension. What else are they spending on?
$700 million for lease payments. Offices, sure, but also those crucial training centers. It shows that even as a tech company, they need significant physical infrastructure for the human element.
Okay, but it's not all rosy. What about financial risks?
Definitely risks.
Right.
The DRHP lists contingent liabilities, potential future obligations, totaling around $556 million as of December 2024.
What makes up most of that?
The vast majority, over $512 million, is for GST demands, currently under dispute. Tax issues.
That's a big number if
Yeah.
they lose those disputes.
It could significantly impact their financial condition, yeah. Managing that kind of regulatory complexity, especially with GST across different Indian states, is a major financial headache.
Got it. Okay, so for your finance podcast series, a good theme might be the margin path, balancing high growth and unit economics in service tech.
Yeah, that works. And here are 5 challenging deep dive questions for a finance leader listening in.
Hit me.
1, when you're deciding how to allocate that IPO money, the $900 million for tech, $800 million for marketing, $700 million for leases, what models or frameworks does the finance team use to determine that optimal split? How do you justify that balance?
Good one. 2, looking at that rising contribution margin, 11.8% to 19.4%. Which specific cost lever inside that calculation offers the most potential for improvement in the next year? Is it getting better deals on supplies for native,
Right.
reducing cloud costs, lowering payment fees? Where's the next point of margin hiding?
3, how does a company strategically manage huge potential liabilities, like those $512 million in disputed GST demands? What specific legal and financial strategies do you put in place to minimize the risk of that actually hitting your cash flow?
4, thinking about those non-GAAP metrics, adjusted EBITDA, contribution margin. How are they used differently for internal decision-making, maybe setting targets for service pricing or SP incentives, compared to how they're presented to external investors? Are the internal hurdles tougher?
And 5, this is a bit niche but revealing. The filing mentions the option for a lower corporate tax rate under India's Section 115 BAA if they give up certain exemptions. Why mention that? What is signaling they're considering this option tell us about their future expectations for profitability? Are they bracing for higher taxable income soon? It's a subtle strategic signal.
Very subtle, very strategic. Excellent questions for a finance deep dive. Okay, let's move to that third pillar. Service professional empowerment. You could argue everything else, the 4.82 rating, the improving margins, depends entirely on the people actually doing the work. This feels like the heart of HR in the gig economy.
Absolutely. The whole model hinges on attracting, training, and retaining high-quality service professionals, or SPs, in what's not a traditional job.
So how do they make it attractive? The DHRP must have some numbers on this.
It does. They provide some pretty compelling metrics. First, scale. Nearly 50,000 average monthly active SPs as of late 2024. That's a lot of people relying on the platform.
And what's in it for the SPS? Money, presumably.
Big time. The document claims their SPs earn, on average, 30 to 40% more than similar workers operating offline outside the platform.
30 to 40%, that's a significant premium. That's a powerful recruitment tool.
Huge advantage. And it's not just higher earnings per job, it's also about efficiency. They claim SPs spend 50 to 60% less time on a job compared to the offline equivalent.
How?
Because the platform handles all the friction, finding the customer, scheduling, payments, admin. The FAP just focuses on the work.
Makes sense. Less wasted time between jobs.
Exactly. And they even compare themselves to other online gig platforms like food delivery or quick commerce. They say their SPs earn 15 to 20% more while working fewer hours.
So they're positioning themselves as the premium gig work option.
That seems to be the strategy. Better pay, more efficiency. That's how you attract and keep good people in a competitive labor market.
But it can't just be pay. How do they ensure quality? Training must be massive.
It is. They talk about a systematic and pretty comprehensive training infrastructure. They're not just onboarding, they're aiming to professionalize these roles.
You mentioned training centers earlier. How extensive is it?
The scale is impressive. They report having 226 dedicated training classrooms.
226. Wow.
Yeah, and the curriculum covers both the hard skills, how to actually fix the AC unit, and the crucial soft skills. Communication, customer interaction, the stuff that directly impacts that experience rating.
And there's a quality loop here too, right? Connecting training back to performance.
Definitely. New SPs get coaching, they shadow experienced mentors, they even get formal certification from the National Skill Development Corporation, the NSDC.
That adds a layer of legitimacy. Recognized credentials for gig work. That's smart.
Very smart. It's part of the empowerment narrative. But here's the direct link between HR and that 4.82 rating we keep mentioning.
Okay.
The system uses customer feedback, bad ratings, or specific negative comments to trigger automated, personalized retraining for the SP involved.
So if a customer complains about, say, politeness, the system flags that SP for targeted soft skills refresher training.
Precisely. The HR infrastructure is actively defending the customer experience metric. It's not just hoping for good service, it's engineering it.
Okay, let's talk welfare. This goes beyond just earnings and training. It touches on ESG, environmental, social governance.
Right. And they seem to be doing more than many typical gig platforms here. They provide core social safety net components.
Like what?
Insurance is a big one. Life, accidental, and health coverage for the SPs. They also help SPs get access to formal credit.
Loans. For what?
Often through third-party partners, yeah. For things like buying the tools they need for the job, which could be expensive, or for personal financial needs, helping bridge that gap since gig workers often struggle to get traditional loans.
That's significant. But you mentioned something even more profound earlier.
Yeah, this one really stands out. It's the specific support program for service professionals who might be facing domestic violence.
Really? What kind of support?
Things like counseling, legal aid, even monetary support and emergency accommodation, apparently run in collaboration with an NGO partner.
Wow. That's a level of commitment you don't often see from a platform company towards its independent workforce.
It suggests a very deep understanding, I think. They recognize that the SP's personal well-being, their stability, directly impacts their ability to deliver that high-quality 4.82 rated service. Its HR strategy deeply intertwined with CX, maybe even operational empathy.
That's a powerful phrase. Okay, what about the corporate side, the internal employees?
Less detail, naturally, but some interesting nuggets. Attrition among key management personnel, the top leadership, is reported as nil, 0, across all the periods they show.
Suggests stability at the top.
Yeah, and employee benefits expense, basically salaries and benefits for the core team building the platform, is a big chunk of costs, around 30% of their operating revenue. So they're investing heavily in the centralized talent, too.
Okay, so for an HR people-focused episode in your series, a great title could be Beyond the Gig, Engineering High Earnings and Social Security for Platform Workers.
I like that. It captures the scope. And here are 5 tough questions for a chief human resources officer or head of people grappling with this model.
Lay them on me.
1. The core tension. How do you design incentive structures and guaranteed payments to motivate SPs, ensuring they're available, delivering quality, without completely wrecking that contribution margin you fought so hard to improve? It's balancing human motivation and financial viability.
Tricky balance. 2. That 4.82 rating is paramount. What's the specific curriculum design and delivery method across those 226 classrooms that demonstrably ensures soft skills training translates into measurable improvements in customer ratings? How do you prove the ROI of soft skills?
3. The legal tightrope again. As a platform relying on independent contractors, how do you strategically navigate the growing global focus on gig worker rights and welfare, especially with specific draft legislation emerging, like those mentioned for Jharkhand and Telangana in India? How do you stay compliant and proactive?
4. Switching to corporate talent. For those crucial, hard-to-hire roles like data scientists and engineers, how exactly are employee stock option plans, they mentioned ESOP 2015 and 2022, structured and communicated to actually win talent against competitors in a red-hot market?
And 5, operationalizing the welfare. What kind of robust system processes and maybe even dedicated teams do you need to successfully manage programs like facilitating loans, administering insurance claims, and running that sensitive domestic violence support program for potentially tens of thousands of decentralized workers across multiple countries? The logistics are complex.
Very complex. Okay, fantastic insights for the people function. Right, we've covered the engine ops, finance, people. Now let's look at the fuel, the customer, and the brand strategy needed to acquire and keep them. This brings us back to that first principle, consumer excellence.
Exactly. And this is where marketing really has its work cut out for it, because the ultimate goal is driving that massive behavior change, shifting people from offline habits to the online platform.
The foundation for that has to be the service quality itself, right? That 4.82 rating.
Absolutely. That high average rating isn't just a nice-to-have metric. It's the core engine for customer retention, repeat business, and word-of-mouth referrals. It is the product in many ways.
And the numbers show retention is working.
Seems so. They highlight that over half, 50.08% of all the customers they've ever acquired came on board just between January 2022 and December 2024.
So recent growth is strong, and the filing explicitly says future success depends on getting transactions from these retained customers.
Yes, it emphasizes reliance on repeat business, not just constantly acquiring new users who try it once and leave. The quality has to bring them back.
Which is critical, given the market context you mentioned earlier. Remind us of that key stat.
It's stark. The DHRP emphasizes the Indian home services market is still overwhelmingly unorganized, fragmented, and predominantly offline. Online penetration? Less than 1%.
Yeah, less than 1%. That's mind-bogglingly low.
It really is. So the marketing challenge isn't primarily about fighting other apps for existing online users. It's about converting the 99% plus who are still calling their local handyman or plumber directly.
Fundamentally changing ingrained habits. How are they tackling that?
With an omnichannel approach, as you'd expect, they invest across the board. Traditional media, digital, influencers, content marketing. Standard stuff.
Anything unique about their brand building?
I think the cultural positioning is quite interesting. They mentioned specific brand films, like one titled Choti Saksh, Choti Baat, Chota Kam, which translates roughly to small thinking, small talk, small work.
What's the angle there?
It seems aimed at elevating the status and dignity of the service professionals themselves, tackling societal perceptions about manual labor.
Ah, so it's not just selling convenience, it's selling respect, both for the worker and maybe appealing to customers who value that.
Exactly. It's a clever dual purpose. It helps attract customers who appreciate that ethos, and it helps attract the high-quality SPs they need to deliver the service and maintain that 4.82 rating. It builds the brand on values.
Smart. But they must be doing performance marketing too, driving immediate bookings.
Oh, for sure. They balance the long-term brand stuff with very granular, targeted campaigns, highly seasonal.
Like what?
Aggressive AC servicing campaigns hitting just before summer. Big pushes for deep cleaning or painting right before major festivals like Diwali, promoting salon and beauty services heavily during wedding season. It's about capturing demand precisely when it spikes, maximizes ROI.
Makes sense. Now, you mentioned another tactical insight earlier, something about breaking down services.
Yes, this is fascinating from a marketing and product perspective. They call it disaggregating large categories into granular subcategories.
Example?
Instead of just offering kitchen cleaning as one big service, they break it down. Chimney cleaning, appliance cleaning, cabinet cleaning, faucet polishing, whatever it might be. Lots of smaller, distinct options.
Oh, why do that? Seems more complicated.
Two key strategic benefits, I think. First, it makes the services seem more affordable individually. A customer might balk at a full kitchen clean price, but trying just chimney cleaning feels less risky, a lower barrier to entry. It encourages trial.
Okay, gets them in the door.
Right. Second, once the SP is actually in the home, having done that initial small job, it creates the perfect opportunity to bundle or upsell those other related granular services. While I'm here, noticed your cabinets could use a clean too. It likely maximizes the average spend per customer visit.
Very clever. Driving trial and increasing average order value. Okay, so for the marketing CX episode, a theme could be converting offline to online, navigating the less than 1% digital penetration challenge.
Perfect. Captures the core problem. And here are 5 pointed questions for a chief marketing officer or head of customer experience.
Let's hear them.
1. How do you actually measure the ROI of those big brand-building campaigns like the Dignity of Labor films, which aim for a long-term cultural shift, versus the immediate, easily trackable ROI of performance marketing like a seasonal AC campaign? How do you balance those budgets?
2, that feedback loop is crucial. The 4.82 rating driving retraining, how is that managed operationally at scale? What systems ensure that customer feedback, good and bad, flows quickly and accurately to trigger the right training or recognition for the SP involved?
3. Let's drill down on that disaggregation strategy.
Yeah.
How do marketing and product teams work together, using data to decide how to break down services into those granular bits? And how do they track its effectiveness in maximizing both initial trial rates and the final average spend per customer?
4, thinking internationally, UAE, KSA, Singapore, those markets are different. Competitors might operate differently, maybe more on a simple lead gen model. How does the marketing strategy adapt? Do you compete differently when facing pure lead generators versus other full-stack platforms?
And 5, brand protection. They mention the value of their trademarks like Urban Company, Native. They also mention threats from copycat websites. What's the active, ongoing strategy, legal, technical marketing for defending the brand and intellectual property against this kind of misappropriation in the digital space?
Excellent. Covers brand, performance, CX, and IP. Great marketing focus. Okay, we've torn through operations, finance, people, and marketing based on this DHRP. Now, let's synthesize this for the listener. You're building this new leadership series. How do you structure it? What are the big cross-functional themes?
Right, pulling it all together. Based on everything in the DHRP, I think you could build your entire series around 3 core recurring themes that cut across all the functions.
Okay, theme 1.
The dual customer imperative. This feels fundamental to their whole model. You absolutely must serve 2 distinct customers simultaneously. The end consumer, focusing on excellence, trust, convenience, and the service professional, focusing on empowerment, earnings, welfare.
And they're symbiotic. If one side falters,
The whole thing collapses. You can't have happy customers without happy, motivated SPs and vice versa. Episodes should constantly explore that tension and synergy.
okay, dual customer imperative. Theme 2.
Tech is the standardizer. We kept coming back to this. Dedicate segments, maybe even whole episodes, to how technology, that huge euro 900 million investment, the smart jigs, the barcode scanning, the algorithms is used to impose order, quality, and predictability on a traditionally messy, human-driven industry. Tech is how they scale trust.
Makes sense. Tech isn't just efficiency, it's the quality enforcer. Theme 3.
The profitability J-curve. This gives you the narrative arc for the financial side. Explore that classic journey of a high-growth, venture-backed company moving from deep losses to, hopefully, sustainable profitability. Use the contribution margin, its calculation, its sharp improvement from 11.8% to 19.4% as the central story device to show how unit economics evolve and improve over time.
Love it. Dual customer, tech standardizer, profitability J-curve, those give a strong through line. Now, how about tailoring content? The listener might be an ops leader, an HR leader, etc.
Good point. You can use the specific data points from the DHRP to frame discussions for different roles.
For instance, for operations leaders listening.
You'd constantly focus on that challenge of rapid growth versus quality control. Reference risk factor 5 directly. Talk about the practicalities of those operational audits, the smart jigs, managing logistics across 59 cities. Make it tangible.
Okay. For HR or talent leaders.
Dive deep into the specifics of the SP empowerment model. Detail the training setup, those 226 classrooms, quantify the earnings advantage, that 30–40% premium, and really explore the unique social welfare and ESG programs, like the insurance and the domestic violence support. That's differentiator territory for HR.
And finally, for finance leaders.
It's all about the nuances of those non-GAAP metrics. How is contribution margin really calculated and used internally? What did hitting positive adjusted EBITDA signal? And dissect the strategic thinking behind the capital allocation. Why $1.9 billion for tech versus $800 million for marketing? Make them wrestle with those trade-offs.
Excellent. That provides clear angles for different functional interests. #tag outro.
So just to quickly recap the big tensions and takeaways from this deep dive, we saw clear quantitative evidence of their service, professional empowerment strategy working SPs earning significantly more.
Right. that 30–40% boost. And we saw the improving unit economics very clearly shown by that contribution margin jumping from around 12% to over 19%. The financial discipline is kicking in.
And underpinning both is the critical role of technology. That heavy investment is enabling quality control at scale, reflected in that sustained 4.82 average rating, driven by things like process standardization and real-time audits.
But let's leave you, the listener, with a final, provocative thought, something directly from the challenges laid bare in this document.
Yeah. Given that this massive home services market is still so overwhelmingly offline, remember, less than 1% online penetration was really going to be the key driver for success in the next phase.
Is it finance having the capital discipline and allocating funds perfectly? Is it technology building ever smarter standardization and efficiency tools? Or is it marketing cracking the code on mass behavior change, finally convincing millions to ditch their local guy for the app?
Which function holds the ultimate key to breaking through that 99% offline barrier? Capital, code, or conversion? Something for you to debate in your own leadership discussions.
That's your next deep dive. Thanks for joining us.